Stocks closing lower with the Dow breaking a 5-day win streak. The Nasdaq also taking a hit, down by more than 1%. The move lower comes as Wall Street digests the minutes from the Fed's last policy meeting. Our next guest believes they reflect a victorious central bank. Paul McCulley is PIMCO's former chief economist. He now teaches at Georgetown's McDonough School of Business. Paul, great to see you.
Good to see you.
So you think they stick the landing here?
So far, yes, I think so. I think today's minutes were fully consistent with what Chair Powell had to say back at the press conference on July 27th, which is the first leg of this tightening campaign was completed. And that first leg was what I can call the hair on fire leg, or the expeditiously getting back to neutral. They knew they needed to get away from zero and get back to neutral as quickly as possible. And they did that. And I think that's essentially what Chair Powell said back on the 27th. The markets celebrated. And I think the minutes confirmed that, that now they're moving into measured probing into restrictive, but they're not guiding us to specific large increases. They become more data dependent. So I think leg one is over. Leg two is still to come. And I think it'll probably be another 100 basis points over the next 6 to 12 months. But leg one is over, and the markets, I think, were validated with the minutes today on the rally off the bottom. Doesn't mean we're going to go at this pace going forward, but this rally, based upon the completion of the first leg of the tightening campaign, I think was justified.
Leg two seems treacherous as well when it comes to the economy, Paul. I mean, that's just from a layperson's point of view. They have to remain sufficiently restrictive. Rate levels are for some time in order to control inflation. It sounds like there is still some question over whether or not they've got the situation under control. Why do you believe leg two won't be, won't have the possibility of a hair on fire recession? I'm not trying to say that I think that you should think that there's a recession, but why can't we take that off the table?
I don't think you can take recession off the table as a tail risk event, but clearly that's not what they are aiming for. They're aiming for a softish landing, sometimes called a growth recession in some respects, not a actual contraction in growth, but a contraction in the growth rate with an increase in the unemployment rate. So that's what they're aiming for, and I think they will be committed to getting interest rates higher at the policy level. But I think they will do it in a more data-dependent fashion and less of a shock and awe fashion, and that they will get up to, call it 3.5 or so. And then the important issue is I think they will stay there for a while. And that was in the minutes as well. So I think this notion that Wall Street is romancing that the peak will be simply a point and then we'll come right back down is overblown. I think the peak will be more of a plateau as they bear down on this inflationary pressure over time, because I think it's going to be difficult to get down to, call it 3%. We can come from 8 to 5 pretty easy, but I think they'll want to bear down on it by having a plateau as opposed to a point peak.
A lot of the scenario that you draw out, Paul, you say this is what the Fed intends to do, what it aims to do. Why do you believe the Fed can do this?
Because the fundamentals of the economy remain sturdy. I think a lot of the slowdown that we're seeing now is taking the froth out of the economy that developed because of the reopening plus the extraordinary fiscal and monetary stimulus. So I don't think there's something corrosive in the economy really at all, that we got above trend, we got above potential, we got too hot coming out of the pandemic, and they're dialing back the heat. But we don't have huge excesses in the economy that need to be wrung out. That would be consistent with a old-fashioned blood and guts recession. I just simply don't see that on the horizon.
Hey, Paul, it's Tim. First of all, go Hoyas, and reminding you everything I know about macro and the economy you taught me at UBS when I was going through the training program in the mid-'90s. So on to what you just talked about, though, where we really are. 100 basis points possible of additional hiking. Is that the neutral rate? And is that slightly above neutral? I don't think so, based upon the inflation readings we have. Is that the place to stop?
I think it could be the place to stop, and the incoming data would tell you if that's the place to stop, we should see signs that that's actually restrictive, that is putting traction on the economy, and that we are below trend and therefore opening up some slack. So I'm putting out 3.5 as the number where they will stop, and that would be restrictive. This whole debate in the marketplace about neutral in some respects is wonks talking way too much. I think the Fed used it appropriately because they print what they think the longer run appropriate value should be if they have perfect equilibrium in the economy, and that's about 2.5. But I think it's also true that what Chair Powell did was to say the first leg of the tightening campaign was over. Or put differently, they are no longer behind the curve. So they're not trying to catch up or atone for their sins of being too easy for too long. They have reached the point where they are neutral, and they will keep tightening, but not with hair on fire, but responsive to the slowing of the economy. And they will stop. They're not trying to induce a recession. They're trying to induce some opening of an output gap, if I can be wonky with you, Tim.
Thank you.
For a man that has great hair, hair on fire is problematic. 1. 2, Georgetown is lucky to have you. The Fed would be lucky to have you. I won't bring up the fact that the bond market trades like a $150 million biotech stock, or that 2s10s are inverted to the tune of 40 basis points. But what I will bring up is they're going to try to basically reduce their balance sheet starting in September. $9 trillion, obviously not all 9, but you know, that's going to be a difficult thing to pull off in the midst of all this, Paul.
I would actually take the other side of that trade with you. I don't think it's going to be terribly difficult because remember, there's a huge amount of excess liquidity in the marketplace, measured in my favorite way with the reverse repo facility at the Fed, which is essentially the banking system parking excess liquidity that was the result of the QE, because there's nowhere to go for it in the marketplace, and that's up over $2 trillion. So the first $2 trillion of quantitative tightening should have de minimis effect on the marketplace from a pure supply and demand perspective. So I would not get wrapped around the axle about this whole QT thing going forward, at least for the first $2 trillion.
Paul, great to have you. We hope you come back to the show
pleasure.
sometime. Paul McCulley, now of Georgetown. Karen Feinerman, what do you think? Do you think that hair on fire recession is a much smaller risk now? Do you feel better after these minutes?
No, I don't really feel better. I feel like they have still a lot of work to do, and I think that inflation's coming down, and I do think we've reached peak inflation, but it's still so far above where it needs to be. So I think, you know, I read that 2 weeks ago of no pivot, that was no pivot. I thought it was hawkish. These minutes sort of say otherwise, but I'm still in the hawkish camp unless we see inflation come so far down, and I'm not that optimistic on that. And so if they have to put us in recession, they will.
Yeah, I mean, I don't think that's their intent to put us in recession. But to Guy's point about QT, I mean, think about what happened to risk assets. Think about the volatility in some of these, you know, large risk assets that we've just seen in 2022 since the Fed did pivot and acknowledge that they had to attack inflation. So we had housing rollover, we had the stock market rollover, we had, you know, a lot of things that weren't particularly comfortable for the better part of this year. So I think as we go into the back half of the year, we might see QT have that same sort of effect as it did, I think, in the lead up to the end of 2021 when the Fed did acknowledge that they have to fight inflation.